How does the settlement date impact option value? Have you ever wondered how the settlement date can affect the value of your options? Understanding this can be key to making informed trading decisions. Let's break it down in simple terms. The settlement date is the day when the transaction is completed. This is when the buyer officially owns the option, and the seller fulfills their obligation. In options trading, this date is crucial because it marks when the rights and responsibilities of the option contract are fulfilled. As the settlement date approaches, the time value of the option decreases. This is because options have a limited lifespan, and as they near expiration, there is less time for the underlying stock price to move in a favorable direction. This decrease in time value is known as time decay. So, the closer you get to the settlement date, the lower the option's time premium becomes, which reduces its overall value. Another important aspect is how the settlement date affects when an option can be exercised or assigned. For equity options, if the option is in the money at expiration, it usually gets exercised automatically on the settlement date. This means that the option converts into a stock position. For call options, this means you will own shares, while for put options, you will be short shares. This conversion impacts the option's intrinsic value and the final settlement price. Now, let's talk about how options settle. Some options requiring physical delivery of the underlying shares, while others settle in cash. In cash-settled options, the value is based on the difference between the strike price and the underlying price at settlement. This means that the settlement date is when this exchange happens, which directly affects the realized value of the option. Another factor to consider is market volatility. As the settlement date nears, traders often adjust their positions to avoid unwanted exercise or to capture the final value of their options. This increased activity can lead to higher volatility, which in turn can impact option premiums and their value leading up to settlement. Lastly, recent regulatory changes have shortened settlement cycles. For example, the shift from T+2 to T+1 means that settlement occurs one business day after the trade date. This change affects liquidity and cash flow timing, which can influence option pricing models and trading strategies, especially for short-term options. In practical terms, knowing how the settlement date impacts option value helps traders manage risk and plan their strategies effectively. Understanding these dynamics is essential for accurately valuing options as expiration approaches. The settlement date plays a key role in the life cycle of an option contract, influencing its market value through time decay, exercise mechanics, and final payouts.